So I want to share today why growth investors are completely wrong. They are completely wrong when it comes to dividend investing. And I receive a lot of questions on my YouTube channel, and a lot of them are from growth investors who ask me, hey Ian, why would you want dividends? Why would you possibly want dividends when you can just own a growth stock and sell shares when you need some income? Sell the shares and you can pay bills by selling those shares. And they cite this example that, hey, when a company pays its dividend, the share price, it actually steps down. It steps down to reflect that dividend. And they say that basically there's no difference between receiving those dividends and selling shares of stock. And today I want to share why I disagree with that philosophy, and I look forward to it. Let's get started. So I want to start out today just with a practical example. This practical example actually confirms what these growth stock investors are saying. But I think it's important to look at a practical example because it gets us all on the same page and it gets us all in the same terminology. And so how many of you out there have heard of these terms before? Record date, ex-dividend date, payout date, these types of terms that are associated with dividend stocks. Well, I want to take a practical example here with Southern Company, ticker symbol SO. This is a utility company. This is one I own in my portfolio. I intend to live off of dividend income one day to pay all of my bills with dividends. And I'm going to link in the description below to my video about Southern Company. The reason today that I'm including Southern Company in this video is because it's a utility and they pay a big dividend. And companies that are utilities that pay big dividends, it's oftentimes easy to look at the ex-dividend date because they paid big dividends, and so it's really easy to quickly see what happens on the ex-dividend date. So let's start with the terminology. When one owns a company, one owns a dividend-paying stock, there's usually an ex-dividend date, a record date, and a payout date. An ex-dividend date is actually a date that when one buys stock on that date, they buy stock on the ex-dividend date. It means they're not eligible for the next dividend. They'll have to wait to the next cycle. If they buy on the X date, it's X dividend, they won't receive the upcoming dividend. They will get the next one though in the next cycle as long as they continue to hold the stock. The record date is the date by which one must be a record shareholder to receive the dividend. It's weird because the record date oftentimes or all the time comes after the ex-dividend date, but the reason the record date is later than the ex-dividend date is it takes several days for stock to settle. When one buys stock, one doesn't own the stock or one doesn't have it fully settled the minute they buy it. It actually takes a few days for the transaction to fully settle. And so that's why the X date is so important. When one buys before the X date, they're eligible for the dividend, meaning that their stock will settle. It will settle by the record date. However, if one buys on the X date or later, that stock will not settle in time for that record date. And so they won't be a shareholder of record to receive the dividend. Then the payout date, usually a few weeks or even months later, is when the dividend is actually paid out. So let's look at this. Southern Company. The ex-dividend date here of 5/18/18, this is the most recent ex-dividend date, meaning people who buy on 5/18/18, they are not eligible for the dividend. However, if you buy on 5/17/18, you are. Your stock will settle in time for the record date and you'll receive the dividend, the upcoming dividend. Right now, Southern Company pays a dividend of 60 cents per share. If you look at this, it closed at 43.62 on 5/17, the day before the X date. And then on 5/18/18, the X dividend date, it opened at 43.13. If I take those numbers and I subtract them, I get a delta of a negative 49 cents. So between closing the day before the X date and opening on the X date, this company lost 49 cents in value. Why is that? The market makers, the people who make the market, the specialists on the trading floor, they're supposed to adjust it down for that ex-dividend factor. And so it dropped 49 cents. It didn't drop the full 60 cents. And sometimes you see that. It won't be perfect, but more or less it's in the range. I'll take another example. 2/16/18, that was the ex-dividend date earlier this year. And the date before that, this was on a Monday, so on the Friday, 2/13, was the day before the ex-dividend date. Now, the day before the ex-dividend date, it closed at 44.56, and then it opened on the ex-dividend date at 43.98. And so if you subtract the two numbers, it dropped 58 cents, which is the same amount of the dividend payout. You can go through some more examples here in your own time, but I looked basically at the last 5 dividend events for Southern Company, and more or less the stock on the day before the ex-dividend date, the close, versus the open on the ex-dividend date, you subtract the two, it's equaling the amount of the dividend. So the stock is dropping, and it drops to reflect the dividend that is being paid out. What these numbers do not reflect is that oftentimes, if you look at a longer time period, if you don't just look at the close on the day before the X date and the open on the X date, if you look at a longer time frame, it really smooths out, and it's really hard to decipher the numbers. And oftentimes it appears when just looking at the numbers that it didn't really drop at all. But from a textbook example, from a mathematical example, looking at the precise numbers, it does in fact in real time drop. And so again, just some valuable information here for everyone who's been struggling with some of these concepts of the X date, the payout date, and the record date. And again, the key thing here with this terminology is the reason the X date comes before the record date is it takes time for stock to settle when one buys the stock. And so it's really important, for example, if someone's trying to buy stock and they want to get the dividend, don't wait until the record date. It will be too late. What one needs to do is buy the day before the X date, because once it goes X dividend, one is not going to capture that most recent dividend. Anyways, a lot of background here, but this is the classical example that growth investors use. And they say, hey, Ian, look at the math. It is plain as day. It is very clear that when these stocks go X dividend, the stock drops in value. And so why do you even care about these dividends? In the broader picture of things, you could just own a growth stock. It could pay no dividend, and you could just sell off shares when you need some income. And that's what I want to discuss next. That's what I want to discuss next in today's video. So this is a key point. I want to talk about the composition of a company. When you invest in a company, are you investing just in the cash assets of that company? Or are you investing in something much greater? I know I'm investing in something much greater. And so when I invest in a company, I'm investing in a bunch of stuff. Of course, I'm investing that they've got some assets, they've got some cash, they've got some property. Oftentimes they own property, whether it's real estate property or even machinery and equipment, assets. I'm buying into their intellectual property, their people, their brand, and most importantly, their future stream of revenue and income. There's a lot of things. Obviously, I didn't list everything here, but there are a lot of things that comprise a company. And so let's say I'm a growth stock investor and the stock I own pays no dividend, and it comes time to pay my bill. I want to pay my electric bill. Okay, I'm going to sell 1 share of stock or 2 shares of stock to free up that money. If I do that, I am selling an entire share. And so if I sell that share, I'm selling it all. I'm not only selling the cash position, but I'm selling the property, the IP, the people, the brand, the future revenue and income potential. I'm selling it all. I'm selling my ownership stake. Let's contrast this with dividends. The reason I love dividends so much is the types of companies I invest, they fund dividends through cash. They fund it through cash flow. And so when a company pays a dividend, I'm able to basically, in essence, sell. I'm able to sell a portion of the cash that the company has accumulated, but I don't sell anything else. I retain the rest. So my 1 share or my 2 shares that I would have sold in the growth company to pay my electric bill, I do not have to sell those stocks at all. The company retains everything, all of the future revenue and income, the brand, the people, the IP, the property even. But what it does is it takes a portion of the cash and pays it out as a dividend. And so this here is the fundamental reason that I think growth investors have it wrong, especially growth investors who feel like, hey, these dividends are just a nuisance. Hey, these dividends I can replicate by just selling stock. Well, one actually cannot do that, because when one sells shares of stock, they are selling the entire company. When one receives a dividend, they are simply receiving some of the cash that the company had accumulated through operations, but the person is retaining everything else, all of the important stuff. Another way I look at it is it's kind of like, don't sell the goose that laid the golden egg. It's one of these things where keep that goose, keep it really happy. Hopefully it keeps laying more and more golden eggs or dividends. And so in that case, you kind of keep your asset, you keep that goose, and when you get those golden eggs, maybe you're using them to pay the bills. Although right now I'm reinvesting my dividends because I want to propel my snowball of income even further. But anyways, that's what one does with dividends. But when one is selling shares, they're literally selling the goose. They're selling everything. They're selling not just the cash portion, but everything, because there is no way in the stock market to break up a stock. A stock is a stock. It's a unit of ownership in a company. Maybe in the future, technological advances that are on the way, maybe one will be able to do this. Who knows? But the way things are right now is one cannot divvy up a stock. They're like, oh, when I sell my stock, I just want to sell some of the cash. I don't want to sell the future revenue and income opportunity. Or they're like, hey, I like this company, but I want to sell part of one of their buildings. You can't do that. But the beauty of a dividend is it literally allows the company to divvy up the company for you. It allows the company to look at everything and sell off just a portion of the cash, or pay off just a portion of the cash to the shareholders. And that is the magic of dividends. So I want to move down this chart a little bit. I have one more reason that I think it is so important. And I think it's so important that growth investors, dividend investors, everyone understands this concept, is when one wants to live off of their investments, they want to live off of cash flow. Oftentimes, if you're like me, you have recurring bills. You have your electricity bill, you have groceries, you have your cell phone bill, you have to pay for gas, you have to pay for new clothes, for food. It's all pretty stable. Surely there's sometimes one-time big events that come up, but more or less one's budget on a month by month basis, it's somewhat steady. And so the beauty of dividends is they're paid out steadily over time. And whether a stock is up, whether a stock is down, as long as one invests in a world-class, great company that has a history of growing dividends over time, the kinds of companies that I like to invest in, like Southern Company, the dividend will keep coming in. And so let's take this example. Great example. Southern Company has been down recently. I like this. It's been a buying opportunity. It's a good thing for 2018. Not a core focus of mine, but I'm picking up some shares. I like the opportunity to buy some Southern Company. In fact, I'll link to a video below. I sold my Dr. Pepper Snapple company this year. It's basically forced to sell it. They're getting acquired anyways. And I redeployed some of it into Southern Company, and some other stocks. I'll link below. It's a good video. But what I love about dividends is, okay, Southern Company's going down. Boy, if I have to pay my electricity bill and I have to sell some of my Southern Company in a down market at lower prices, and not only do I have to sell at a lower price that I believe is undervalued, but I have to not only sell the cash portion of the company, but the entire company, the entire goose, that's crazy. That's just not going to work for me from the standpoint of paying bills. But if it pays a dividend, and the dividend is increasing over time, it's steady, they're paying it out like clockwork even though the stock is down, I have no problem with that. I have no problem taking that cash dividend and paying bills, if I have to, while keeping my stock, while holding on to my stock. And so, moreover, it gives me the opportunity to buy more stock like I have been when it's going down. I don't want to sell this company when it's going down. I want to buy more. I want to buy the stock, buy the asset, and use the dividends, the cash portion that's being paid out, to pay my bills. And I think this is so fundamental because a lot of growth stock investors these days, they've done well, and I commend them. That's great. It may not always be that way. These FANG stocks, the FANG stocks, they may not always go up like a hockey stick. There may be downturns, and if one wants to pay their bills, they want to pay their bills from one of those stocks, one has to be mindful, hey, when there is the downturn, am I comfortable? Am I comfortable selling portions, shares of my position to pay bills? Or would it make more sense to have dividends coming in so that I never have to sell those shares, especially when they're going down and I believe they may be undervalued? And so this is why I think growth investors have it wrong, and why I think, even though, yes, it's true, when the ex-dividend date comes, the stock will drop. It will drop, a dividend stock, by the amount of the dividend that's being paid out. It's true. Although, again, look at longer time frames and it kind of works its way out. I've always seen that it works its way out over time. But that's true. But even despite that, why would I want to own dividends? For these reasons. I don't want to sell shares because I just don't want to sell the entire company. And I don't want to have to time the market. When it comes time to pay bills, I don't want to have to worry if a stock is down. Now, there is a whole multitude of other factors not listed here why I love dividends as well. Dividend-oriented companies tend to be shareholder-focused. They tend to love their shareholders and reward their shareholders with dividends. Dividend-oriented companies, in my opinion, tend to be better at managing their money, because whenever someone has a lot of money sitting around, it's human nature to want to spend it. And so I love having a company that pays out its dividends to shareholders so that they can be a little more scrappy. They don't have that distraction of all that money sitting around like that. And I think also just investing in dividends, it's a very positive experience from an investment standpoint, because when the stock market is down, that's my favorite time to buy dividend stocks, because the yields, the starting yields, go up. When stock goes down, the yield goes up, because the yield is the dividend divided by share price. And if the share price goes down, my yield goes up. And so I love that. And so there are many reasons I love dividend stocks, but just speaking at a high level here, this is why I think the growth investors have it wrong. So what did you think about the video today? Are you a growth investor, a dividend investor? I'd love to hear from you. I'd love to hear what your opinion is on this topic. I think it's a really important topic. I'm very thankful for all the comments, the questions here, and I'm thankful for all viewpoints. This is not just a one-sided channel. This is a channel that supports all different types of investors. And look, I have participated in growth opportunities in the past. I'll link in my description below. In 2017, I made a ton of money on Bitcoin in terms of my percentage returns. I did well, and I sold it, and I redeployed that gain into income-producing assets. And so the fact of the matter is I dabble in growth from time to time, although my core focus is always going to be dividends, cash flow, passive income. But please voice your opinions here. Everyone is welcome. And I'll link, by the way, in the description below to that Bitcoin video I just talked about. I think you'll get a kick out of it. It's a fun one. And thank you. So anyways, before I leave today, I wanted to offer a full disclosure. I am a shareholder. I am long. I own Southern Company, ticker symbol SO, in my personal portfolio. And also, just a friendly disclaimer today, this is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Thanks again. Channel is growing. We're almost at 8,000 subscribers now. Thank you. If you have an opportunity, I'd love a comment, a like, a subscription. All of that means the world to me. It's the best way that you can thank me for producing these videos. I will see you in the next dividend investing video.